Introduction. The capital markets now has fundamental importance within the whole development process of the world economy. It is in principle a realization of dynamic transaction environment, a system that distributes the securities to provide liquidity to securities issued by companies, enabling the capitalization process these. Companies have sought to meet its financing needs for its activities increasingly through the issuance of securities in the capital market, and less the loans from banks, which in some cases may cost more high. The pursuit of profit, the emergence of the major economic groups, consumerism, unfavorable market conditions, among others, may cause an imbalance in the relationship between suppliers, consumers, and investors. Here appears one of the issues that will be the object of study. May be used by investors in the capital market the same protection mechanisms for consumers? These two institutes can be treated. Speculation, illegitimate and illegal, capital markets may cause serious damage to investors. The high and low in the price of securities can result in high profits to speculators, especially those holding privileged information, and, on the other hand, will cause severe losses to investors. Insiders, as these speculators are called, draw on information not yet disclosed to the market to obtain illicit gains. Such situations need to be inhibited through the use of various mechanisms to maintain the credibility and transparency of the capital market. Companies that offer and negotiate their securities in the capital market must continually be concerned with transparency, with the provision of information and disclosure of relevant facts, making them widely known to investors. The capital market is a major source of application of financial resources, is also critical to the development of enterprises, and consequently across the country, as it promotes the financing of companies, providing capital to cover its investments. The businesses that offer and trade their shares in the capital market must always be concerned about transparency, provide information to the market, and disclose relevant facts. The high and low in the price of securities, which are normal when it comes to the smooth functioning of capital markets, can lead to undue and high profits to those who hold privileged information not yet disclosed to the market, insiders, creating with it serious damage to investors. It is essential to grant protection in a contractual relationship where there is an imbalance of power between the participants. The investor, when you use the securities it has saved and applied them in the capital market, is acquiring goods and services in this market, is learning securities and using the service offered by the intermediaries, the management of their investments. So this investor, acting in an unprofessionally market rather than being institutional investors, should be equated to the consumer. Can the investor seek compensation for damage suffered due to the improper handling of the capital market conditions? However, the protection of investors is not intended to eliminate the natural hazards of the capital market, or to ensure profitability, or provide favorable economic results. The capital markets must also be based on ethical values. Chapter 1. Law, Economy, and Financial System. Although they are entirely different science branches, keeping a distance from each other, law and economics now need to walk together in order that the law is present in the economy aimed at regulating economic relations, drafting contracts, resolve conflicts of interest, and therefore critical role in the economic organization of a state. However, both must have their delineated fields of action and respected so that there is no harmful interference from an area on the other. We will study the evolution of economic history, the rise of commercial companies, and we will review the corporation. Of great importance to this work, the corporate governance, the financial system, capitalism, and globalization. In the early days of civilization, man lived in caves, then went on to organize themselves into tribes, walked in groups, moving in search of food and shelter. Social groups were enough by themselves. They used what they obtained from nature or produced what they had the need for their survival. What was overproduced by some group has become an object of exchange with what was overproduced by other social groups. However, it was a crude form of commerce, since it was not always produced in excess by a group other needed. The ancient tribal assemblies, where men and women gathered to make decisions that affected everyone, gave rise to the first kingdoms and agricultural empires. With agricultural civilizations, the man began to organize themselves into kingdoms under the monarchical form, with powers in the hands of the landowners who did not share their power. Came the first cities, then the first states, with their peculiar characteristics. The Phoenicians are considered by some authors as people who practiced trade on a large scale. Greece emerged contracts such as the maritime exchange. It is noteworthy, then, the great commercial development of cities located on the banks of oceans. These cities have promoted various treaties and agreements to regulate their trade relations. The production system reached ever higher levels, scientific knowledge evolved, was created a certain political structure, and the intellectual and artistic manifestations flourished. It also happened the changing needs of man, searching for new goods and more sophisticated products. There was a development of communities, surplus economic production, and an emergence of different consumption habits with new and varied needs. The development of industrial civilizations also caused changes regarding the state organization. The development of trade gave to traders increasing strength to the state, and they began to demand a government system with features that met the dynamism of its activities, and without the absolutism of monarchies, who refused to meet the needs of business. Therefore, the strengthening of merchants' class causes, in some states, the replacement of the monarchy by republican forms of government. The organized states could not remain indifferent to speculative activities, and had to go to intervene in trade relations, aiming to seek balance, avoiding risky activities, and looking for their survival through the collection of taxes. The state began to regulate business, establishing restrictive rules, and even forbidding the exercise of certain activities. It was the development of domestic and international trade, and emerged in centers where businesses performed, markets and fairs. In the markets, sites located in cities, the products obtained by farmers were sold, and were also acquired other goods produced by the local community. Already fairs were held sporadically, and traders gathered from various locations to market their products, and it was more intense in the Middle Ages. The major European expansion, which took place from the second half of the 15th century, was a major factor in the characterization and formation of the modern world. It was a commercial expansion in search of routes and warehouses to obtain goods and significant commercial demand for products and high prices in the European market. With the increasing colonial exploitation by European countries during the centuries that followed, they have created conditions for the emergence of the first industrialized economies. The major European commercial states in the early 17th century were England and the Netherlands, because of their geographical locations, such as the European continent gateway, facilitating trade routes and the commercial tradition. The French business also had an increasing level of development, and that France was one of the major European agricultural powers. Arise factories, bringing together workers in places for the production of manufactured goods, with greater profitability and productivity. There was a significant concentration of population in cities, leaving the countryside. An example of this phenomenon was the city of London. In the late 16th century, had around 200,000 inhabitants, and, a century later, had around 600,000. The Industrial Revolution represented a significant evolution of the productive forces, because until then it was produced using the man himself, tool work, combined with his personal effort, the strength of water, wind, or animals. Developed a factory system, came the machines, driven at first by the power of the water, leading to significant innovations in the textile industry. However, hydraulic power was not enough. There were then the first steam engines, which caused the great revolution with the use of steam in various types of machines in different business lines. Britain becomes the most significant world power. After that, there was a rapid development of production systems, increased productivity, human growth prospects. All these changes caused reflections in all other fields of science, giving impetus to alter the way of life of the person. The development provided by the Industrial Revolution, with the creation of machines, new energy, new labor, caused an acceleration of inventions, new alternatives of transport, new economic models, among others. The Industrial Revolution led to the foundation with greater vigor a new economic and social system that guided the economic activities in the pursuit of profit. Capitalism. Chapter 2. The Financial System. The state has as its primary objective the welfare of its population. For this to occur, should promote, among others, the regulation of various activities to achieve their goals. The financial system is one of the components of the complex production chain, since through it are obtained financial resources that may be investment object to develop the country, generating jobs and income. The financial system consists of the set of institutions and instruments dealing with the transfer of resources between those who have the excess, surplus, called offerers, and those who need these resources for their expenses and investments, named borrowers. The institutions that make up the financial system can be bank or non-bank. The financial system takes care of the entire chain involving from the savings accumulation by some, and the need for these resources by those who wish to consume or invest and need the resources of others. It takes care also to provide advice to investors and other miscellaneous services. Therefore, the financial system provides all the necessary infrastructure for the proper functioning of capital markets, which is inserted in its scope. Search, in short, to maximize the circulation and use of financial resources. The capital market depends not only on stock exchanges and its organizational structure to promote trading of our securities. The entire financial system is involved, directly or indirectly, with the smooth functioning of capital markets. Noteworthy is the performance of banks, since most investors do not have direct access to capital markets. Thus, banks act as intermediaries in their negotiations. The term financial markets can be split to create two types: the financial market in the strict sense and the capital market. In the first, the channeling and mobilization of financial resources are hired by a financial intermediary that stands between the investor and the recipient of the investment, and typical roles of banks, which capture values with customers and lend to third parties for remuneration. In the capital markets, funding ratio is established in a direct manner between the provider of funds and the beneficiary. If the corporation were a major driving force behind the development of the industry on one hand, the capital market, to generate resources for investment in companies, also represented a huge factor in business development on the other. In this chapter, we will deal with the origin and evolution of the capital markets, its operating structure, and its role in the global economy. For a better view of the capital market origin, it is necessary to view its source and its grounds, which involves the study of the origin of the currency, the financial system, among others, as discussed below. We must take into consideration that, as distinct sciences, law and economics, but need to go hand in hand in this work, have separate and delineated fields. While economic theory is concerned with the financial resources, its use efficiently both by individuals and by society and businesses, the law has in economics an analysis element in the pursuit of justice. The origin of the money goes back to primitive societies, when man lived in small groups, nomadic groups, who performed rudimentary forms of economic activity based on the exchange of food and animals. What was produced in excess, it was stored for own consumption and to trade within the group or with other groups. This direct exchange is called barter. With the growth of production and increase in inventories groups, who were nomads began to settle in some locations, taking advantage of increasing periods of prosperity. The activities of individuals within groups became better defined. The exchanges started to be realized with more intensity. Barter was gradually giving way to trade products that had a general acceptance, being accepted without further restrictions. Salt, for example, was a product that was used as a bargaining chip. The currency has since gone on to play a vital role in allowing for exchanges, reducing the costs of economic transactions, also serving as standard in the valuation of the assets. Disappeared the need for convergence of interests among individuals interested in the exchange. Chapter 3. Capital Markets. The term capital markets is usually used as a name for the different segments of the capital investment market. Capital here refers to an active income generator and can exist in the form of cash or securities, known as financial capital. The growth and development of the capital market are directly linked to the process of economic development of a country, while contributing fundamentally to this evolution, though, for example, the generation of new jobs and income. Through this market, companies get financial resources to finance their development projects. Companies, when they need financial resources, may use the capital market through the trading of its securities. Those who have the financial resources to implement may use the capital market to promote the purchase of these securities. Thus, this market consists primarily of those that need to raise funds and those that have these features to offer. Many countries, including Brazil, have sought in recent decades to stimulate the financing of business activities and the development of business by raising funds from the securities market through the opening of the capital of companies. This funding model is less costly for businesses than the way hitherto traditional financing obtained from the banks. The opening of capital also has other advantages to shareholders because it can generate to maximize the value of the block of company stock control, distribution of project risks with the investor, able to sell their shares in the market, among others. Are fundamental characteristics of capital markets its momentum and liquidity of investments, given that the purchased securities can be sold at any time in the same market. Global competitiveness also contributed, and also has contributed to the increasing importance of capital markets for the economies in general. Organized capital market allows the investor some possibilities, such as the conversion of net assets in fixed investments, i.e., allows the saver to apply their savings in the capital market, and in turn, the company can use this money in investment direct the purchase of equipment, for example. It also occurs in the capital market the sum of small and sprayed investments that together become significant capital investments in companies. Increased reliability and confidence levels in the capital market made him assume over time the important role in the capitalization of business. There is no denying the significant advantage to business in obtaining funds through IPO in the capital market concerning bank loans, given the collection by banks high interest rates. This capital market's conveniently structured, managed, and protected, it proves to be of great importance also in the function of making dynamic transfers and activities related to saving, and ample opportunities and investment opportunities. Of undeniable significance in this context is the issue of transparency, since all relevant information that can influence the investor's mind, enabling offerers and demanders are better informed, must be notified immediately. Chapter 4. Primary and Secondary Market. The company's access to capital markets is divided into two phases. In the main market, in short, the company launched its shares on the market and got the resources in your box. In the secondary market is the trading of securities on the market without directly reach the financial situation of the company. There are securities trading and creating liquidity. Main market. A company in need of funds to finance its projects, you can get them through the conquest of new members if the current shareholders fail to subscribe for shares in a new issue. These new partners, to acquire the shares of that particular company, will inject new funds, which will go to the expansion of the business, and may result in the company's growth, and consequently increase in the value of shares, pay dividends, among other benefits. This market is, on the one hand, the company is negotiating the sale of new shares to the public, obtaining financial resources, and on the other side are the subscribers of these actions, which are those who acquire and pay for them. The shares belong to the company. They are traded for the first time, and the money raised goes directly to the issuing company. It is private subscription if the former company's shareholders to acquire these shares. What gives character to the public IPO is the search for new shareholders and the sales effort. Such public releases are called Underwriting Operation. A financial intermediary is responsible for the company, placement of securities in the market. The underwriting can be performed by a single financial intermediary or by a consortium of financial institutions. Only public companies can make public issuance of shares. To occur as opening, the company needs to be adjusted to the rules and requirements of the market, including the reorganization of the corporate structure, adaptation of the bylaws, hiring independent audit. The whole IPO process needs the approval and registration of the Securities and Exchange Commission. The underwriting process can be of three types: firm, residual, and best efforts. In firm underwriting agreement, the institutions fully subscribe the shares and pay the issuer the total value and subsequently sell such shares to the public. The company is not at risk, since it is the intermediary itself who acquires the shares, assume the risk of accepting or not the shares on the market. The residual or standby agreement is made an initial effort to sell the shares on the market for a specified time. After this period, the shares were not sold and are purchased by the underwriter. Here, too, the company has a guarantee of placement of shares on the market without risk. The contract of best efforts. The risk is entirely the issuing company, and the intermediaries undertake merely to put the shares on the market. Brokers are committed to effecting their best efforts in the sale of shares to the public. The fixing of the stock price is one of the fundamental steps in the issuance of the action, with a view that will directly influence the success or not the issue of shares. The price must be satisfactory to the company, should dilute the risks of the underwriter, and to return to the investor. Through marketing, should be brought to the attention of the audience the company's image, through brochures, advertising materials, among others, providing they have a view of the future results of the company. Secondary market. In this marketplace, sales and purchases of shares purchased in the primary market. The investor intends to convert its investments in money, and thus puts its shares to be traded. Here occur the exchange of shares between investors, without the participation of companies. The buying and selling options are intermediated by brokers. Therefore, the primary function of the secondary market is to provide liquidity to the shares of companies that raised funds through the main market. Countermarket. The name OTC is because investors interested in trading securities be served at the tables of financial institutions, remaining in place to be informed about the effectiveness or otherwise of the business. Here they are traded securities of private companies, not registered on the stock exchange, and who do not wish their securities are traded on the stock exchange. Some companies opt for this market order not to incur higher costs IPO. The company is who decides whether his actions will be or not traded on stock exchanges. A company will only be considered open if you have shares traded on the stock exchange. If the company does not want its shares are traded on the stock exchange, the purchase and sale of these securities may be made through the non-counter market. This market has no physical location, works through financial institutions that conduct transactions among themselves and on behalf of its clients. A corporation shall act as the public issue of shares, will hire one or more institutions to which they, through their outlets, branches, stores, etc., promote the sale of their rolls. The primary placement of papers takes place exclusively in the OTC market, called in English as over-the-counter. Financial institutions and other entities authorized to operate it do it directly with each other or with their customers, without the necessary centralized mechanism of price information. In the OTC market is promoted all trading of securities is held outside the stock exchange, but since agents who act appropriately in the distribution system. It can function as the primary market and also as secondary. However, the shares sold in the secondary market through the stock exchanges have greater liquidity in the OTC market. Stock exchange. The origin of the stock exchange is remote, and there is no consensus among historians about the correct date. Some argue that originated in the emporium of the Greeks, others in funducs, bazaars, of the Palestinians, and others in mercatorum collegium of the Romans. The term exchange had its origin in Bruges, in Belgium, where he held meetings of traders in the master's house, Vanderbeurs. Only in the 18th century, the bags reached greater development with the expansion of corporations, enabling large grouping of resources with the bags the key role in the supply and demand of capital. The above definition should be supplemented to include the stock exchange is the place, even if virtual, where buyers and sellers to present their proposals and close deals of interest. Still, the stock market is the entity that manages the site and the trading system, as well as processes affected operations. The advent of technologies that allow electronic negotiation processing has allowed increasingly performing remote operations. The stock exchange may be constituted as a corporation or as a nonprofit civil association. Your heritage is represented by securities belonging to brokerage companies, members of the exchange, subject to the supervision of the Securities and Exchange Commission, but has administrative, financial, and patrimonial autonomy. Chapter 5. Market Operations. The purchasing types, order, and sale of shares of the stock exchanges are market order, which is one in which the operator can meet the best price of the moment. A limit order is one in which the operator has a maximum rate limit for purchase and minimum for sale. In order married, the operator has two kinds, and conducting a depends on the completion of another. For the day, if the operator cannot carry out the order by the end of the session, it will be cancelled. And finally, the order for an indefinite period is that one that remains open until it is filled. Arrangements operating. Stock exchanges operate in the following modes: the spot market, the forward market, futures, and options market. Spot market. It is the purchase and sale of a particular number of shares on a trading floor for immediate settlement. Trade stock up on standard lots and odd lots. In Brazil, there are standard unit lots of 100 shares, 1,000 shares, 10,000 shares, and 100,000 shares. The forward market. The investor agrees to buy or sell a certain amount of shares at a fixed price and a predetermined time. The transaction consists of the purchase and sale to settle future date. It is the negotiation between seller and buyer, where they combine the conditions, price and time, and the date right is the completion of the transaction. Future market shares. In the stock market, future is negotiated with future settlement dates. The purchase and sale of shares are held in the present, but with a settlement date in the future. The expectations of buyers and sellers are opposite, i.e., buyers believe that the stock price will rise, and sellers that they will fall. Options market. Market options are traded the rights to buy or sell a predetermined price, a certain number of shares, by a date previously stipulated by the stock exchange. The buying and selling positions can be closed at any time by the investor, perform an original-to-back transaction at a profit or loss. The buyer of the option holder has the right to buy the seller of the option, which is the launcher, an amount of a given action at a price specified in advance. They put option holder, a seller of the option, has the right to sell the caster some particular action for a price already set. Home broker. The use of electronic media and computers in conducting business, several signings, has grown sharply in recent decades due to the high technological development and facilities and rationality by these systems. Trust has the key role within the context of the use of computer systems for the execution of commercial transactions, since such systems are now used on a large scale for the execution of electronic contracts, given that the user needs to be sure to be performing transactions legitimate. Electronic commerce is opposed to the traditional trade, since the negotiation acts are carried out remotely, without the present face-to-face buyers and sellers. Currently, we found that some activities were carried out daily over the Internet. Several online stores sell all kinds of products, books, music, travel, clothing, food, among others. The great allies and fundamental in carrying out the transactions are credit cards, which are the means of payment, and post offices, which are most often the delivery of products, should be pointed out. Also, The high presence of banks on the Internet and through your sites offer almost all types of services and contracts access to the current account, etc. E-commerce is then a way of hiring the distance between people who communicate electronically, virtually providing the product and the other affecting the purchase. However, as are the issues surrounding the protection of this consumer against any irregularities or abuses resulting from this electronic contracting. Note that the electronic procurement transactions are effected at a distance. As discussed earlier, the manifestation of the will takes place through clicks and imposter passwords on multiple links, which will appear as the party concerned declares its willingness to get something. Hiring takes place, so very different from the traditional, which is treated by the legal provisions. The consumer takes risks by acquiring a product or service virtual way. As occur fraud and falsification of information are created illegal sites, among other known scams. There may also see, touch, or try the product. Occurs delay in delivery of the purchased product, the misuse of their personal data, among others. Good faith is the highest principle that permeates the electronic contracting. The consumer is taken to purchase a good or service of possession of information that is provided at that time. Here, the supplier does not appear, has no face, it does not have a physical structure. There is a hiring change without dialogues, solitary, faceless. It can be considered that there is no will of agreements, but only the standard consumer of membership that is offered him. Conclusion. Duty of information and the right to information. Nowadays, because of the significant evolution of the media, the scientific and technological development, operations on the stock exchange have become very agile, and the information spread very quickly. The decisions and changes in the companies occur rapidly, and information across the oceans and reach the markets very soon. The provision of information to the market and to investors by companies that negotiate their assets in the capital market, it is crucial to provide certainty and transparency to materialize business. The adequate protection of the investor stems from the prompt dissemination of reliable information, which may influence the decision of investors to buy and sell its securities. Those who issue securities to be traded in the capital market have a duty to report immediately on the set of facts related to their activity and who have significant influence on the stock price or its ability to meet the commitments arising from the issue titles. The duty of disclosure is in an investment protection instrument, since through it is possible to assess better the risk associated with a particular investment, as well as to act more safely and efficiently in defending their interests. The information that has to be relevant should be accessible to all, so that everyone can have equal conditions in the assessment of the risks of their investments and make the markets safe, reliable, and immune to fraud that could result from the abuse in the use of information. The duty to inform by companies is the fact that is suitable to affect the stock price and or the company's ability to meet commitments. The need to provide information to the investor is not intended to prevent this, does not incur risks, because this is inherent in the capital markets. The right to information enables the investor to avoid taking certain risks because of the lack or inaccuracy of information needed. There is an information asymmetry between those who deal directly with the company's business, or those who have, for various reasons, access to privileged information, and, on the other hand, investors lacking detailed information on the trading conditions of their values securities. The need for information to offset the referred asymmetry thus has a double relevance. On the one hand, at a general level, while conditioning element of market stability, and secondly, the investor level, as a mitigating element of the risks to which it is subject and which are derived directly from the very informative imbalance, leading in a broad sense to what can be termed a risk information. This imbalance may well result in the absence or lack of information which puts investors in a situation they cannot accurately assess the transaction in question and its possible consequences. We should point out, too, it is also important to note that there are limits to this duty to inform. The obligation of transparency by the company is limited and must cease the moment that the disclosure of information could harm the progress of its business.